Hi, I'm Grant Mundell, investment specialist at Equity Trustees with our February monthly market review. Given events in the Middle East that have transpired since the end of February, we'll also outline our current views. The time of recording this is the afternoon of the 11th of March. Firstly, in February, Australian equities outperformed global equities as US equities relatively underperformed. The theme towards increased diversification continued as market leadership broadened, supported by robust economic conditions and strong profit growth. At the same time, investors have more deeply scrutinised the winners and losers from artificial intelligence within the tech sector and beyond. Physical assets and some old economy value sectors have witnessed renewed interest. And overall, in local currency terms, the ASX 200 rose 4.1%, outperforming global equities ex-Australia up 1%. While index gains were solid, there was large divergence between the sectors. In Australia, banks and resources led the way, with consumer staples also outperforming, and this was mostly due to strong results from the major players in each sector, along with continued rises in commodity prices. Notably, large caps in Australia outperformed small caps by 7.4%, driven by BHP and Commonwealth Bank, which both rallied 17 to 18% over the month. Healthcare, IT and consumer discretionary were the laggards during the month. Healthcare suffered from disappointing updates from CSL and Cochlear, while IT stocks suffered as investors continued to price in risks of disruption from artificial intelligence. Size, value and momentum factors outperformed, while growth and quality factors continued to struggle. The headwinds to quality and growth company performance has been quite remarkable over the course of the last 6 to 12 months. Reporting season locally and offshore was solid. In the US, Europe and Australia, more companies beat earnings and dividend expectations than missed, and future earnings were upgraded. Locally, increased single stock volatility continued to be a reporting season theme, with stocks moving violently both ways. Turning to the macro, well, locally, the RBA raised interest rates in February 25 basis points to 3.85% and signalled to more hikes amid inflation pressures. Economic growth gained momentum in the second half of 2025 and started to back up against capacity constraints, leading to higher than expected inflation outcomes. However, it was the US and Israeli attack on Iran which has captured much of the headlines since the end of February. Leading into the conflict, the global economic and corporate environment has been robust, with both monetary and fiscal policy accommodative. The Middle East conflict remains fluid and uncertain, and these types of events are always concerning for investors, giving increased market volatility. The key focus of the market is how long will this conflict continue for? While many would have suggested the US would have been after a short-term offensive, crippling Iranian weapons and infrastructure, halting nuclear developments, and cultivating regime change, the resolute Iranians have combated this through fearsome defence, engaging Middle Eastern neighbours, attacking energy infrastructure and shipping canals, and appointing a new supreme leader. We suspect President Trump is likely keen to seek an off-ramp, given the impact to oil and gasoline prices in the US, and less home support for such an offensive, especially as it approaches the US midterm elections. Our positioning leading into this conflict had been to be tactically slightly underweight equities, given higher than average valuations, which left little room for adverse events. In instances such as this, the market moves to a risk-off mode, selling high-risk assets such as equities. Oil importing regions such as Europe, Japan and China have suffered more selling, given the closure of the Strait of Hormuz and attack on energy-producing infrastructure in the Middle East. While we are watching events closely, we take heart in the fact that historically, geopolitical events such as these have turned out to be good medium-term buying opportunities. Valuations have become more appealing now following recent drawdowns, and at this point, earnings haven't been aggressively marked down. The world is less sensitive to energy prices than they once were, given increased energy efficiency and the growth in the services sector. The global economic and corporate backdrop has been resilient, and several economists forecast the global economy can weather a period of higher short-term oil prices. And Australia is relatively well insulated, and the US is a net energy exporter. Therefore, we would highlight that there have been geopolitical events in the past, and whilst there have been short-term bouts of volatility, over the long-term investment markets recover. Timing is very hard, so it's best to stick to your long-term strategy and remain invested to participate in the good days. We've been advocating for increased diversification in portfolios where you're invested in assets with uncorrelated return profiles to reduce the volatility in your portfolio and preserve capital. We believe in investing in quality securities which are well managed, well governed, have strong balance sheets, participate in strong industry structure, and that also are reasonably priced. And while share prices can be volatile, underlying earnings and dividends are less volatile, especially when investing in quality securities that produce sustainable growing cash flows. I'll be again next month for the update for March.